Welcome, everyone, and thank you for joining us today. We're excited to talk about one of the most underutilized wealth building strategies available to investors using retirement accounts to fund investments. Today's presentation will walk through how self-directed retirement accounts work, the types of accounts that can be used, how investors are leveraging retirement capital for real estate and alternative assets, and strategies like Roth conversions and solo 401ks that can dramatically improve long-term wealth creation. Our goal today is to simplify these concepts and show you practical ways investors are using retirement dollars to diversify beyond Wall Street and participate in opportunities like multifamily real estate, private equity, and other alternative investments. Let's begin with the basics. What exactly is a self-directed IRA or SDIRA? A self-directed IRA is still an IRA under IRS rules. It has the same contribution limits and tax treatment as traditional retirement accounts. The difference is control. Instead of being limited to stocks, mutual funds, and products offered by a traditional brokerage firm, a self-directed IRA allows you to invest in alternative assets that you choose. With traditional custodians, they typically control the investment menu. Most large financial institutions focus on publicly traded investments such as stocks, mutual funds, ETFs, CDs, and annuities. With a self-directed IRA, you gain the ability to direct your retirement capital into a much wider range of investments. That can include real estate, private equity, private lending, real estate secured debt, cryptocurrency, precious metals, and even traditional market investments if desired. The key takeaway is that you are no longer restricted to a narrow list of investment products. You gain the flexibility to truly diversify your retirement portfolio. The phrase self-directed simply means you're in the driver's seat. You decide where your retirement funds are invested. Instead of relying solely on Wall Street products, investors can pursue opportunities in real estate, private equity, private notes, forex, syndications, and many other alternative assets. One important thing to understand is that alternative investments inside retirement accounts require a specialized custodian. The custodian's role is to hold the assets on behalf of the retirement account and ensure IRS reporting requirements are met. There are several major advantages to using a self-directed IRA. First is tax advantage. Depending on the type of account, investments can grow tax-deferred or tax-free. Second is investment flexibility. Traditional banks and brokerages often restrict investors to their own financial products. Self-directed accounts open the door to real estate syndications, private lending, hedge funds, private equity, and much more. Third is administrative simplicity and transparency. Many self-directed custodians operate on flat fee pricing instead of charging a percentage of assets under management. And finally, true diversification. Many investors believe they are diversified simply because they own multiple mutual funds, but often those funds hold similar underlying stocks. Self-directed accounts allow investors to diversify into entirely different asset classes that may behave differently than public markets. There are several common reasons investors choose to use retirement funds for alternative investments. One is diversification. Investors want exposure to assets beyond traditional market investments. Another common trigger is a job change. When someone leaves an employer, they often gain access to roll over their retirement plan into a self-directed account. Some investors also use retirement funds because they already have capital tied up elsewhere and want additional liquidity for new opportunities. And finally, tax mitigation plays a major role. Investors are often looking for ways to grow wealth more efficiently inside tax advantage structures. Many people are surprised by how many types of retirement accounts can actually be used. Eligible accounts often include 401ks, 403bs, 457 plans, previous employer retirement plans, traditional IRAs, Roth IRAs, SEP IRAs, simple IRAs, even other vehicles like thrift savings plans, qualified annuities, HSAs, and Coverdell education savings accounts may qualify in certain situations. The key is understanding the rules and structuring the rollover or transfer correctly. One of the most common funding strategies is a direct rollover from a previous employer retirement plan. Funds from a 401k, 403b, TSP, or 457 plan can typically be moved directly into a traditional IRA without triggering taxes. This is known as a direct rollover. The money moves from one qualified retirement account to another while maintaining its tax-deferred status. For many investors, this is the first step toward accessing alternative investments. For Roth retirement accounts, the process is similar. Roth 401ks, Roth 403bs, and Roth TSP accounts can be rolled into a Roth IRA or Roth Solo 401k. Again, when structured properly as a direct rollover, no taxes are triggered. This preserves the post-tax status of the funds while allowing investors to pursue broader investment opportunities. In addition to rollovers, investors can also complete trustee-to-trustee transfers. This allows funds to move directly between IRA custodians without taxes or penalties. Traditional IRAs, SEPIRAs, rollover IRAs, and seasoned simple IRAs can all generally be transferred. This process is often faster than employer plan rollovers because assets are moving between custodians rather than being distributed through an employer plan administrator. Roth IRA transfers are very straightforward. Funds move directly from one Roth IRA custodian to another Roth IRA custodian. Because the funds remain within a Roth structure, no taxable event occurs. This gives investors flexibility to change custodians while preserving all Roth benefits. There are several important rules and operational considerations when using retirement accounts for investing. First, a custodian or administrator is required. Second, the investment must be made by the IRA itself, not by the individual personally. That means all cash flows, returns, and distributions must flow through the retirement account. Third, timing matters. Establishing and funding a self-directed account can take several weeks. And finally, active employer 401k funds are often restricted unless an in-service rollover is allowed by the employer's plan. It's important to understand these operational details before beginning the process. A checkbook IRA is a structure where the IRA owns a manager-managed LLC. The IRA remains the owner of the LLC, while the investor serves as manager. This gives the investor direct control over a bank account owned by the LLC. The major benefits include faster transaction speed, easier access to investment capital, limited liability protection, streamlined investing for real estate transactions. This structure is especially popular among active real estate investors who want quicker access to funds for closings, lending, or operational expenses. This slide shows how the checkbook IRA structure works. First, retirement funds move into the self-directed IRA. The IRA then owns 100% of a single-member LLC. The investor acts as manager of the LLC and controls the LLC bank account. All investment activity, including expenses, income, profits, and distributions, must flow through the LLC bank account. This creates flexibility and speed while still maintaining the proper retirement account structure required by the IRS. While checkbook IRAs provide flexibility, they also create additional responsibility. Investors must understand prohibited transactions and disqualified persons. There can be no commingling of personal and retirement funds. All distributions must flow properly through the custodian. The account owner is responsible for maintaining records, bookkeeping, and compliance. Because of the increased control, investors must be extremely disciplined to avoid accidental violations of IRS rules. The IRS has strict rules regarding prohibited transactions and disqualified persons. Disqualified persons generally include the account owner, parents and grandparents, children and grandchildren, spouses, certain entities controlled by those individuals. Prohibited transactions can include selling property to the IRA, lending money between the IRA and disqualified persons, furnishing services to the IRA, personally benefiting from IRA assets. For example, if your IRA owns a property, you cannot personally renovate it, repair it, or use it. Understanding these rules is critical to maintaining compliance. Now let's transition to solo 401k plans. Solo 401ks can generally be funded in two primary ways. rollovers from existing retirement accounts, and ongoing annual contributions. This combination of high contribution limits and flexible investment control makes the Solo 401k one of the most powerful retirement vehicles available for business owners. Most retirement accounts can be rolled into a Solo 401k. These include traditional IRAs, SEP IRAs, simple IRAs after seasoning, 401ks, 403bs, TSP accounts, 457 plans. One major advantage of the Solo 401k is that it can contain both traditional pre-tax and Roth post-tax buckets within the same plan. This creates tremendous flexibility for investment and tax planning strategies. Solo 401s offer significantly higher contribution limits than standard IRAs. Contribution amounts are based on earned income. The plan allows for multiple types of contributions: employee deferral contributions, employer profit-sharing contributions, and employee non-deductible contributions. Together, these can create very large annual contribution opportunities. This is one of the reasons Solo 401ks are extremely attractive for self-employed professionals and business owners seeking accelerated wealth building. Contribution deadlines and setup requirements vary depending on business structure. Sole proprietors, partnerships, S-Corp, and C-Corp each follow different filing timelines. One important point is that employee deferral elections generally must be made before year-end. Employer profit-sharing contributions may have additional extension deadlines. Understanding these timelines is critical to maximizing contributions and avoiding missed opportunities. Not everyone qualifies for a Solo 401k. These plans are designed for business owners with no common law employees. Exceptions may include a spouse, business partners with ownership interests, certain younger family members, employees below minimum hour thresholds. The business owner must also have earned income. If multiple businesses exist, controlled group rules may apply, making tax and legal guidance extremely important. Controlled group rules are important for determining Solo 401k eligibility. Generally, if an individual or married couple owns 80% or more of multiple businesses, those businesses may be treated as one controlled group. If one company has employees, that could disqualify the owner from using a Solo 401k. This is why investors with multiple entities should work closely with a CPA or qualified advisor. This slide illustrates an example where no controlled group exists. If ownership is split in a way that keeps the individual below the 80% controlling threshold, the Solo 401k may still qualify. These rules can become technical very quickly, so personalized guidance is extremely important when structuring retirement plans around multiple businesses. A properly structured Solo 401k includes several important components. These include plan documents, adoption agreements, trust agreements, record-keeping systems, IRS compliance support, bank account setup. Good administration is essential because the plan owner is effectively acting as the trustee and administrator of the plan. Proper records and reporting help maintain compliance and simplify tax filing obligations such as Form 5500-EZ. Now let's talk about one of the most powerful wealth building tools available inside retirement planning, Roth conversions. A Roth conversion is the process of moving funds from a pre-tax account into a post-tax Roth account. The investor pays taxes today in exchange for future tax-free growth. For investors expecting significant appreciation over time, this strategy can be extremely powerful. This illustration shows the transition from a traditional pre-tax account to a Roth post-tax account. The idea is simple. Pay taxes on the seed, not the harvest. Once assets are inside the Roth structure, future growth and qualified distributions can potentially become tax-free. The Roth conversion process typically involves 5 steps. First, both traditional and Roth accounts must be established. Second, those accounts must be funded. Third, the investor submits a Roth conversion request. The custodian then issues IRS reporting forms documenting the conversion. For more advanced strategies such as discount conversions involving private investments, a fair market valuation may also be required. These strategies should always be coordinated carefully with a CPA or tax advisor. There are several important things to understand about Roth conversions. You can convert part or all of a traditional IRA. Conversions can be completed multiple times during the year. The deadline for a tax year conversion is December 31st. And importantly, the converted amount becomes taxable ordinary income in the year of conversion. This is why many investors carefully plan conversions to stay within favorable tax brackets. This comparison highlights the long-term power of tax-free compounding. Taxable accounts lose a portion of growth each year to taxes. Traditional accounts defer taxes, but Roth accounts allow qualified growth and withdrawals to occur tax-free. Over decades, the compounding effect can create substantial differences in ending wealth. This is why many investors prioritize building Roth assets whenever possible. There are several common Roth conversion strategies. The first is converting gradually over multiple years to manage tax brackets. The second is deal-specific conversions, where investors target particular assets or investments. And the third is the discount conversion strategy. This approach involves valuing private investments during periods of reduced valuation and converting them into Roth status at that lower value. These strategies require careful coordination with tax professionals and valuation experts. This slide demonstrates how broader tax brackets can create opportunities for larger Roth conversions. When tax brackets are expanded, investors may be able to convert more assets into Roth status without moving into significantly higher tax rates. This creates planning opportunities that investors should evaluate carefully with their CPA or financial advisor. This case study illustrates how a solo 401k investor might use a Roth conversion strategy in a real estate syndication. In this example, funds are rolled into a solo 401k. The investment is made through the pre-tax bucket. The investment value later declines temporarily. A Roth conversion is completed at the lower valuation. The investor then pays taxes on the lower value while positioning future appreciation inside the Roth bucket. If the investment later recovers and grows significantly, that future upside may occur in a tax-free environment. This example highlights why strategic tax planning and timing can have a major long-term impact. Thank you again for spending time with us today. We covered a wide range of retirement investment strategies, from self-directed IRAs and checkbook IRAs to solo 401ks and Roth conversions. The key takeaway is that retirement accounts can become far more powerful when investors understand the rules and use them strategically. At this point, we'd love to open it up for questions and discuss how these strategies may apply to your specific situation. Thank you again for joining us. We appreciate your time and participation. We hope this presentation helped clarify how retirement funds can be used more strategically to build long-term wealth through alternative investments. If you'd like to discuss your situation further, schedule a one-on-one conversation, or explore whether a self-directed IRA or solo 401k makes sense for you, we'd be happy to help. Thank you, and we look forward to connecting with you soon.